Most landlord tax content tells you what you can claim. This video does the opposite because claiming the wrong thing is one of the fastest ways to trigger an HMRC inquiry. I'll take you through the property costs that are non-deductible, the ones that are only partly deductible, and why getting this right matters even more under Making Tax Digital. Start with the big one: capital versus revenue. Revenue costs, running the property, are deductible against rent. Capital costs, acquiring or improving the asset, are not. So, stamp duty on the purchase, the legal fees for buying, and improvements like an extension, a loft conversion, or a significant upgrade kitchen are all capital. They don't reduce your rental profit. The good news? Most of those capital costs do count later, reducing your capital gains tax when you sell. So you're not losing them, you're claiming them in a different tax at a different time. Keep every receipt. Next, personal use. If you use a property yourself, the costs for that period aren't deductible. The classic example is a holiday let. Say a Cornwall cottage is let for 40 weeks and used by your family for 12. Total running costs are £12,000. Only the let portion is deductible, 40 or 52 weeks, about £9,231, and the £2,769 for your own use is disallowed. The same applies to a property a family member lives in, rent-free or well below market rent. That's personal use, not a void period, and HMRC has successfully challenged landlords who dressed it up as a void. Then there are mixed costs. Partly business, partly personal. Travel to your properties for inspections and repairs is deductible. Most landlords use the simplified mileage rate, 45 pence a mile, up to 10,000 miles, then 25 pence, and you must keep a mileage log. Useful to know, traveling from home to your rental is generally deductible. It's travel to a place of business, not commuting. Phone, broadband, and a home office can be claimed on a reasonable, documented percentage of business use. The key word is reasonable. Pick a defensible basis and apply it consistently. Legal fees trip people up constantly because it depends entirely on what the work was for. Deductible, lease renewals and extensions, evicting a tenant, recovering rent, and professional fees for managing the business. Not deductible, the legal fees for buying or selling the property, those are capital, and legal costs for planning applications for improvements. Remortgaging legals sit in a grey area. If it's refinancing the same property business, they may be a finance cost. If you're drawing equity for personal use, they're not deductible at all. The purpose of the borrowing decides it. A quick run through the rest: stamp duty on purchase, capital. Your own time managing the portfolio, no deduction ever, however many hours you put in. Capital improvements, not repairs. Fines and penalties, HMRC penalties, council fines, unlicensed HMO penalties, never deductible. And mortgage capital repayments, not an expense under any basis. One important clarification: Section 24 mortgage interest is not non-deductible in this sense. It's a separate category with its own 20% relief, so don't lump it in with these. Why does this matter so much under MTD? Because these items flow in through bank feeds and manual entry, and if they end up in your quarterly updates as expenses, every estimate is overstated and HMRC sees it in real time. The clearest approach: exclude known non-deductibles at the point of entry. SDLT, purchase legals, capital repayments, and for items that need apportioning, either record the business portion only or record the full amount and adjust at the final declaration. Whatever you choose, agree it with your advisor and apply it consistently. 3 common mistakes. 1. Claiming SDLT or purchase legals against rent. 2. Treating rent-free family occupation as a void to keep the expenses. 3. Claiming a capital improvement as a repair. All these are easy to make and all 3 are visible to HMRC. 5 recommendations. 1. Separate capital from revenue at the point of entry and keep capital records for CGT. 2. Apportion any personal use costs honestly and document the basis. 3. Keep a mileage log and a consistent home office percentage. 4. Classify legal fees by purpose, not by who sent the invoice. 5. Build a short per property disallowable checklist at the start of each year. Personal use and anticipated works remortgages, so these never slip into your quarterly figures. Myth: if I spent it on the property, I can claim it. Reality: capital costs, personal use, your own time, and penalties are all off limits against rent, though some count for CGT later. RentalBux enforces property categorization at the point of entry, flagging and excluding known non-deductibles and supporting percentage splits for mixed costs, with a year-end review screen for the items you've parked. Start your free trial or book a demo to see it on your own data.